What is up, Zinger Nation? Welcome back to another episode of Benzinga Live. I'm your host, producer AB. It's good to be back after, last Thursday we weren't able to do a show as we had a webinar. We do have my man Ryan Pannell back. We got him back from California. Excited about that. So here in a minute or so, we will bring on Mr. Pannell, get an update on the DIP ETF and everything else going on at Kaiju ETFs. Before we do that, quick rundown of the major indices. The S&P 500 trading down about 0.7%. Your Qs down about 1%, and then the Dow Industrial Average down about 0.7. So overall, red day. Tech showing a little bit more weakness today. Chinese stocks are down on some growth concerns over there, so we'll talk about that later in the show, as well as some other big headlines, including a preview of Apple's new iPhone coming out, what it means for the company, some interesting numbers regarding gambling, sports gambling numbers that could make DraftKings, etc., a potentially interesting play. And again, we will get to that later in the episode, but let's get to my man Ryan Pannell again from Kaiju ETFs. Without further ado, bring Ryan on the stream. What is up, Zinger Nation? Welcome back to another episode of Benzinga Live. Happy Tuesday, everybody. All right, Ryan. With a slightly different background today, but we got you back from.
I'm back in Geneva. So that's so
California.
Yeah, California was a
Geneva,
a whirlwind.
Where in the world is Ryan Pannell? From California to Geneva. Well, it's good to have you back, Ryan. Overall, how was the conference? What's new?
It was great. Future Proof is an awesome event. It's only its second year, and it's just a monster. I mean, it is the world's largest wealth conference. So you have all of the top advisors, you have all the top derivatives manufacturers, you have the top RIAs all in one place. It's out on the beach. I think they had 10,000 one-on-one meetings in the course of 2 days. I know we had, I don't know how many we had, 60, something like that. And it's just when you're in these one-on-one sessions, the tents that they're in just ramp up like a bunch of jet engines. So there's that. I was fortunate enough to be asked to headline a panel on the Tuesday on breaking barriers in asset management. So sharing the stage with Jennifer from Engine Number One, Jennifer Grancio, and Bob Elliott from Unlimited, and of course Hamilton from JP Morgan. And Sean Aloka from ETF.com was the moderator, did an awesome job. And it was nice just to be able to answer some questions on, my part obviously was on the AI component in terms of breaking barriers. So it was a good group, good panel, awesome event. It was nice to connect to with some of your team members too. Renato and Scott were fantastic to talk to. Renato was fantastic to talk to, and Scott, of course, was like our identifiable pylon because he's like 7 feet tall, and you can see him anywhere in the conference. So pretty decent.
That's awesome. I'm glad you guys had a good time, Ryan. So let's talk about a few. I mean, I want to hear about some of the things you discussed during this panel and how kind of AI and especially, actively managing funds with AI, how that plays into breaking these barriers in asset management.
Yeah, it was an interesting group to talk to because, I mean, when it comes to talking to your viewers here, most people, I think, who are, watching this program or engaged with Benzinga are largely, active traders. They're into self-directing their portfolio. They're very, very hands-on, often dynamic in terms of the portfolio management, even if they're position traders. And on the other side of that are the large registered investment advisors, right, which have billions of dollars under management, and they're looking for a safe haven for their investors' capital. And so where in a group like this, forum like Benzinga, I think people are looking for, how AI can generate alpha for them. Like where can I use this to optimize my performance, my workflow, et cetera? The other side of that is, this, $9 trillion of AUM out there on the RIA side. That's like, okay, I recognize that it might be powerful, but I'm really worried about how it could ruin everything. So you're sort of, for me, it was nice to talk to a different group and address some of those concerns. And whether you are a retail trader, whether you're an RIA managing $9 billion or $30 billion, a lot of them have the same questions, like the same questions I've had here before, which is um, around the guardrails that we have in place with the AI. How do I know that it's not just going to blow up with all of my money? It's just going to ride a bus off a cliff. Or understanding that, like, crazy as it is for me to say, I said it on the stage, I'll say it here, crazy it is for me to say, the reason that none of us can share our model outputs with interested investors is the regulators literally prevent us from doing it. Like, it's not about secret sauce or we don't want to, or, well, we don't really share that information. Hell no, we are dying to share it. And the SEC and FINRA say, can't share it because they, at this present point in time, they can't tell the difference between a quantitative back test, which historically, they've prevented dissemination of because they're hugely unreliable and generally misleading, and a mathematically validated AI model, which then executes in real time on model afterwards. So wouldn't you want to be able to share that with the investors so that they could properly position size, better evaluate your product, get some comfort if you're not awful? Like, there are all these valid reasons for sharing this, but we're not there on the regulatory side. So when people come up, when I do these live casts and they say, well, where can we find more information and how can we get some of your model results? And you tell them, like, we're legally not allowed to, it just blows their mind. It's like, how's that helpful? Well, that's a good question. So, you hope, send a letter to the SEC folks, send a letter to FINRA. Please ask them to let us share our model results with you so you can make better informed decisions and evaluate our products clearer. That was a huge part of the conference.
Yeah, that makes a lot of sense. I mean, it doesn't make a lot of sense that those regulations would be in place. It makes a lot of sense why you would want, to be able to do that. So, Ryan, I know recently Kaiju just rolled out some of the first refinements to the DIP ETFs algorithm. Can you tell us what those were? Are you guys working on those refinements? Are you got all the time on your strategies?
Yeah, absolutely. I mean, as you know, we have a number of different AI curated and directed strategies. Most of them operate on our private fund side. DIP is our flagship ETF, shortly to be followed by other products that we've created. And our teams are constantly refining the strategies. Like, we get to a point where they substantially do what we want them to do with an acceptable risk envelope, and they're stable, and we have multiple layers of security and redundancy, and we push them out to investors or to the broader markets. But that doesn't mean we just sort of let it run and it's like, well, yeah, that's doing fine. We're constantly looking at refinements that we can make. Some of that is not directed by the AI, but highlighted, as you know, with the machine learning that's applied to our strategies. The system has the ability to alter its code over time, not completely, but it will weight criteria that it examines differently over time. If it finds that the original criteria it was examining maybe isn't as indicative of positive outcomes that it thought it was, and it'll weight something else. So when that starts to happen, we examine the potential reasons why it's doing that. And then if we can make refinements to the benefit of the investor, we absolutely always will take that opportunity. So this time around, it wasn't so much a refinement as the handcuffs that DIP was forced to go out the door with. Handcuffs directed by some of our partnerships that were obviously concerned about the world's first fully AI curated and directed ETF and didn't want it to go down the toilet with everybody's money. So we were originally hampered by weighting at the sector level instead of the industry level. Now we weight at the industry level, which is, allows us to skew more into better alignment with our benchmark, which is the S&P 500, especially in tech. And we originally had to limit ourselves to a maximum of a 20% per day rebalance. And like, that may already seem crazy. It might be 20% per day. Like, that's huge turnover. It's over 100% a week. Yeah, and that's to the benefit of the AI, right? Like these types of short-term trading systems that are, we find, have high probabilities of success, depend on the ability to be agile. So you take, for example, the regional banking collapse that happened this last spring, right? It's a pattern the AI has never seen before. The ETF sells down. It takes 2 days for it to figure out what's going on. And then it says, okay, I know what this is. Now I want to pivot. I want to shift direction. I want to dump this inventory and I want to reload for something else. But if you can only reload 20% per day, then each day you have to choose between getting rid of some of the old inventory that you still don't want and banking the profits of what you just put on yesterday when there are profits. So it's not overly helpful to have a restriction like that, which obviously isn't 40 Act. It's not a regulatory requirement. So those handcuffs have come off. I mean, you can look at the last 4 months of DIP's performance here. I mean, 4 months, it's about 3 times the S&P. 2 months, it's over double the S&P. When you let AI be AI in these types of systems, these systematized strategies, it really is to the benefit of the investor. So it was nice that we got to finally do that.
Yeah, I mean, you mentioned the agility, needed to navigate a situation like the regional banking collapse, and I mean, I know one of the changes you mentioned was that the DIP ETF will now be able to rebalance up to 100% of the portfolio daily if it needs to. That's huge turnover. I'm guessing you would not have done that if you guys didn't think it was a good idea. But can you tell us exactly why that is? Like why it would be a good idea to turn over maybe 100% of the portfolio in a single day?
Yeah, sure. I mean, you can think of it from the perspective of like a self-driving car, right? If you're cruising along in the car, perfect road conditions, then the AI system that's driving that car is taking these road and condition samples at some interval, right? Maybe it's once every 3 seconds, once every 5 seconds. And the less variability there are in the conditions, the longer the intervals might be. I'm just making it up here, but maybe it's once every 5 seconds because there's nothing really to report. If you have terrible conditions, low coefficients of friction, you've got, winding roads, you've got all kinds of challenges, it's detecting uneven pavement, then maybe it's ramping up to check the road conditions like several times a second, right? Just to make sure that it's as agile as possible. And so that's really what you want in a system like DIP. Like it's not going to turn over the portfolio 100% every day. It does not normally do that. It doesn't need to do that. But when there's some collapse, some crisis, some event, don't you want it to be able to pivot as fast as possible to take advantage of that new condition? I mean, that's what, as traders, that's what we do, right? The conditions change, you conduct your analysis, and you make dynamic, agile, immediate changes on the fly intraday. And that's why we don't just throw all of our money into an index fund and check it quarterly to see how it's doing. So same thing with the AI. When you're talking about these types of very short-term predatory systems, then the more it's able to rebalance, and adjust, the better for it. Again, to capture that alpha.
There you go. Yeah, so it's kind of like, taking the training wheels off, letting it do its thing with full freedom. Gonna go ahead and pivot here, kind of change subjects, Ryan. But you played competitive polo for 15 years when you were younger. And I know, someone in the audience might be, Aaron, why are you bringing this up? But I'm curious, are there any lessons or values that you learned during your time in competitive polo that you apply to your work at Kaiju?
I think you're bringing it up because it sounds crazy. That's my guess, Aaron. You're like, who the hell plays polo? Yeah, I did for 15 years. When I was younger, I loved riding, and as a Canadian, polo's kind of like hockey on horseback. You get to ride around on a horse, you hit a little ball, you're going stupidly fast, it's extremely dangerous, you get to crash into people. Cool sport. is there anything that I would apply to my trading, to my business skills that came from polo? That's a good question. It's tough. I would say, yeah, the collaborative aspect, right? I mean, like, I show up on these shows and I'm this talking head and I'm representing Kaiju, but there's a deep bench of talent at this shop. Like, there is no chance that I achieve any of this by myself. I have a foundationally important role here, no question, but it's a handoff. I come up with the strategies, I teach it to the AI team, the AI team teaches it to the machine. Once we've collectively refined it over, hundreds to thousands of iterations, the dev team brings it into like actual functionality, like takes it from the whiteboard and makes it an interactive tool you can use. Our traders, are constantly giving feedback on market mechanics. Like, polo, you need the freaking horse. You're just a backpack, basically, right? The horse is the athlete. Yeah, fine. You got to hit this ball the size of an orange made out of compressed plastic going 50 miles an hour while some insane other person is trying to knock your head off at the same time, and you run the risk of severe injury. But there's no way you're succeeding unless you and the horse are completely in sync. You're working together to achieve this goal. For me, that was the most satisfying part of that sport, is knowing that you had this moment, right? The horse doesn't freaking speak English. You don't have a telepathic bond, but you would have these moments where the horse would understand what you wanted to accomplish and would make the changes necessary in the moment at speed to get that done. And that is, a company working at peak efficiency. It's fantastic to see from the intern on up, somebody come to work, bring their A game, and deliver an idea, a change, a refinement that you didn't have. And the collaborative environment just absorb that and make it a reality. It's pretty cool to see. I hope everyone gets to experience that at some point.
Yeah, that's really interesting. I've honestly never even really thought about polo or like playing polo.
Why
So
would you?
yeah, exactly. That aspect of kind of just needing to be very reactive and reacting like in real time to what's going, because you don't have, I guess, full control again, like you said, of what the horse might be doing at all times, but you can guide it. You do what you can and working with your teammates. So I don't know if I ever get an opportunity to play polo, maybe I'll have to check it out, Ryan.
Give it a shot. Fair warning, it's hugely addictive.
Okay.
There's a reason I don't play it anymore.
Yeah. So for our Kaiju kicker this week, Ryan, I thought it'd be interesting to talk about material non-public information, otherwise known as insider trading. This is something that you hear about a lot in Wall Street movies and shows and whatnot, but like, how often does this actually come up in the professional finance world?
Yeah, I think actually that's an interesting topic to cover, and I'm glad you brought it up because I know when I started a long time ago as a retail trader and you're struggling with consistency with your profitability, and you are completely convinced that somewhere out there, somebody has all of the best trades. They've got all of this knowledge. And if only you could find where they're getting this knowledge, you too could have these results. And you think it's information. The saddest example is, anyone on a Yahoo Finance thread that's saying, anyone have any good stocks to trade today, right? That's your first indication that you probably shouldn't be trading. But the short answer is, like, this is just 99% a myth. Like, it makes for really good television. It makes for good movies because it's freaking illegal, right? So, and it can be profitable. But the reason that it's a myth is our whole world is return on risk. That's all we basically do is risk management, right? And it's the worst return on risk. Like, think about if you're watching this and I gave you a tip of something that's going to go up 20% tomorrow. But if you trade it, you will not only lose your license to trade, like, you will never trade again for the rest of your life. You will be fined up to or in excess of whatever the hell you made. and then you will probably go to jail. Like, who takes that bet? It's a terrible bet. So, a couple times in my career, never a professional, but somebody that I knew in a business context would come up and say, hey, you didn't hear it from me, but, and I would turn around and say, like, you just guaranteed I can't trade that. Like, I might have found that using quantitative methods. I might have seen the signal in the noise, but because you appeared and gave me this quote unquote hot tip, you totally screwed me. Now I can't trade this. So, there is no vast quantity of secret information that results in profit. On the professional side, we do all the same things that retail traders do. If we're quantitative in TAC, we look at signal in noise. That's what we're looking for. We're looking for markers that precede predictable movements in price. If we're fundamentalist, then we are poring over the same quarterly reports and looking at the same news sources, including Benzinga, Bloomberg, or whatever that you guys are looking at. Like, it's the same thing. So the profitability, consistency and profitability doesn't come from secret information. It comes from discipline and having a trading system that you follow religiously. And while I hate to say it, that's really the difference maker in retail versus professional, is that, and I was the same way. When I was a retail trader, I bounced around strategies and methods, and maybe I'll try this, and no, that didn't work, I'll go over here. At the end of the year, how do you have any sense of your consistency? So long story short, no. Material non-public information, or what we call the dirty edge, is great on TV, looks cool on Wall Street or Billions or whatever, but you would never be able to operate like that. The SEC is actually really, really good. Like, really good. I mean, maybe you could get away with it once if you wanted to risk your whole career in jail over a trade. But like, as a Bobby Axelrod, there is no way that would ever work. Not ever. So there's my passionate answer for you, Aaron.
Yeah, that makes a lot of sense. I've never thought about that aspect of it, that if someone kind of, without you even asking, passes you a tip, not only it kind of screws you, because now you can't, like you said, you can't trade that asset, you can't trade that equity. So, yeah, I mean, it's something you hear about a lot from. I mean, I was in the gym the other night at the sauna, and people were talking about. It was over Labor Day weekend, and they were like, "Oh, all the Wall Street guys are on a boat right now, talking about exactly what the market's gonna do this week and how they're gonna trade it." And all of us, and I'm like, first of all, like, none of these guys, like, they're all probably with their own family. Like, none of them are hanging out on a boat together right now over Labor Day weekend. And second of all,
we don't generally share information with the competition, right?
Right, like they're
no
all working against each
with other
Yeah.
asset managers like, so bro, what do you like? We don't
Yeah.
really talk anyway. If we talk, we don't talk about work at all. And yeah, if somebody throws you the quote unquote hot tip, like, it's like you would never be invited on that boat again. I can tell you that.
These guys were trying to make it sound like they were all together on the boat, being like, yeah, and the S&P 500 is going to move down 8 points this week, and then next week it's going to go back up when we're going to do this and that. I'm like, no one knows, like that's not how it works. But it's like they've had this idea in their mind, and that's what they believe. So,
you pick your favorite icon and Google their wrong predictions. Like, I don't care if it's Kathy Wood or Ray Dalio or Carl Icahn or whoever it is. Like, just to make yourself feel better, if you Google like Ray Dalio worst predictions, like, they're wrong. Like, at least half the time. Ray Dalio is wrong actually more than half the time, but he has this killer asymmetrical return on risk, which makes him money. But yeah, there's just no secret room. So don't feel left out. Doesn't exist.
It's like, look up the times though that even the experts get it wrong. It's like when I go on YouTube and watch golf professionals, hit shanks, and I'm like, hey, see, they do it too. I'm not that bad. Makes me feel better.
Absolutely not.
All right, Ryan. Well, enjoy the rest of your Tuesday. Great to have you back on the show today. Looking forward to talking to you next week.
Super. Thanks, Aaron. Have a good one.
Of course. All right, guys, that was Ryan Pannell. Kaiju ETFs. Going to go ahead and drop that link in the chat. So if you want it, DIP, DIP, that is the ETF. that Kaiju is managing, actively managing with AI. So some very exciting things happening in the capital management world. I mean, we're just going to see more and more of that. But Kaiju and DIP, some early innovators. If you want to go check it out, again, link is in the chat, dipetf.com. All right, guys, let's go ahead and pull up my Benzinga Pro. We'll run through some stocks today. If you've got any trades or stocks you want to check out, drop them in the chat. Would love to take a look. So you've been watching Apple a lot the past week or so. Apple, of course, took a dip down on a few different headlines, came back a little bit yesterday, trading down again a little bit today, but relatively flat. So this is, we're getting kind of into the zone now for Apple where the new iPhone's coming out. We're going to start getting some preliminary numbers back. If the iPhone's not doing well, Apple stock could be in a little bit of trouble here. With that said, I said this last week. I still hold it, to be very true. I think it's true. It's not financial advice for sure. Basically, over the past 20 years, or really since 2008, any substantial dip on Apple stock, you could just buy and make money. A lot of people will tell you, oh, those times are over. The big caps aren't going to do as well right now, yada, yada. I still think that's, a pretty... that's what I'm doing right now. I'm buying Apple shares if they go down another 5% here. You can look at the chart. We hopped back up to around 190. We hit right around 200. This is when Apple, crossed the $3 trillion mark. Let's see what the market cap. Yeah, market cap is well under $3 trillion today. So, look, I mean, you're running a risk here where there's already been some headlines about the iPhone isn't as the demand isn't there for the iPhone. People are less than impressed by it. And then you put that also against the backdrop of a potential some sort of an economic slowdown. I mean, people are probably not going out and upgrading their phone if they are trying to cut back on spending, pay off their credit cards, or they're worried about losing their job, whatever it is. Again, with that said, a forward PE, Apple 26 right now, relatively, I mean, it's not cheap. Price to sales of 7.3. Again, not cheap, but relative to Apple's standards, pretty affordable to get Apple at around 177 right here. If I had to be a buyer or seller right now, I would be a buyer, but that's with the caveat that I'd want to be holding this stock for at least 6 months to a year, right? I'm not trying to play this as a swing trade and say, I think the Apple iPhone sales are going to be so great week one, the opening week it comes out. So that's why I'm buying the stock. That's not what I'm doing. I'll be buying it for a long term, kind of buying the dip. Like maybe the DIP ETF is buying it. I don't know. But yeah, again, about a 10% discount from where the stock was at its all-time highs just a few months ago. Now let's get into some other stocks we're looking at. We do have, this is one that DraftKings. Look at this chart. This is a good-looking chart in terms of you had this consolidation down here where the stock found a bottom. Let me zoom in here. We're looking at a daily here. May 20th, 2020, stock was at $9. January 2023, about 7 months later, still there. So it went through this kind of phase where it ripped up to 22, came all the way back down, but it kind of found this bottom, right? Let me draw this line right here. And you can see, it kind of found this bottom. And that's what I like to see on a beaten down stock like this that's down 80%. It kind of finds this bottom, starts consolidating, and then starts slowly, going back up here. It doesn't shoot back up straight, but it kind of has this nice gradual trend of getting back up. And you can see right here, I mean, this would be my price target right here where, over time, and we've still got a ways to go there. I mean, that's right around $48. Now, this is one, unlike Apple, I would be willing to swing right now, and here's why. We're starting to see some numbers coming out, and not just from the sports betting world, but from the casino world as well, that shows that gambling is up. And in some ways, that's very concerning because I think you typically see gambling up, tick up in times of economic uncertainty, recessions, etc. And right now, if those numbers are ticking up a lot, it could be a sign of some underlying problems, sure. But what it's not bad news for is companies like DraftKings, that you have more and more people betting at casinos. You have more and more people gambling on sports and football. The numbers I saw indicated that the logins of sportsbooks this year are up about 150% from last year. So that's a big increase in terms of people gambling on their phone, and again, also at casinos. So look, is DraftKings probably a little bit expensive here where it's at? Yeah. Um, let's see when earnings comes out next, because like if you wanted to be safe with this, that's what I would do. Is I would wait till so earnings don't come out till November 3rd, so that's not for another month and a half. I'll probably scoop up some shares, kind of just start like very much just make a starter position. Gambling is discretionary. Don't see it in a recession. Um, I, yeah, I don't know. Let's look at some numbers. I don't know. Do people keep gambling? I always thought vices like alcohol, gambling. Fact or fiction, gambling, business. I've always like heard that, but maybe it's just a myth. I don't know. Let's try to find like a more reputable source. By the way, European Business Review. This seems somewhat reliable. JK, the thing won't even load. All right, how about this? Yeah, so it does. Yeah, I mean, it makes sense, right? If people just have less money, I think probably relative to other things, people probably keep gambling a little bit more than they should in recessions. Um, but you're right, Jay, that it probably does dip down a little bit. But yeah, we'll see if if you want to take it safe, I would wait till the company reports earnings, see what they say. Wait, so if the company reports for Q3, okay, so yeah, Q3 would include, see, but that would just be July, August, September for Q3. Which doesn't really include a lot of NFL season, which is going to be DraftKings' biggest, sports gambling, but it will include like the first few weeks, which probably I think would be enough to understand. Okay, the numbers are a lot higher here the first few weeks or through September, and probably just in general, I would imagine that like more people are gambling on like the first few weeks of the NFL than week 8, just because it kind of, I don't want to say it gets stale, but people are much more excited about the NFL season week 1, and there's a lot more promos and whatnot going on than again later in the season. So shall see. Gambling wasn't really legal. Yeah, that's true, but I mean casinos were, so you could still look at casino data. Again, I think like, okay, so take something else that's very discretionary, like sporting event attendance or ticket sales for sporting games. If those drop 20% in a recession, or other things drop 20%, I'm saying I think gambling would drop like 15. Like it probably drops with the drop in expendable income, but I don't think it drops as much relative as other discretionary things, because look, say what you want about gambling, if you can go spend $250 at the Tigers game or $250 at the casino, at least you have a chance to get that 250 back. At the Tigers game, you don't. So, as a form of entertainment, it makes sense why during a recession, people would maybe be more willing to spend their money on that rather than on an avenue where they know for damn sure they're not getting their money back. Um, yeah, I mean, Gambling is one of those things, like a lot of other things, drinking, etc. If you can handle it in moderation, great. If you can't, then you can't, and it's not for you. I mean, I think Mickelson, less about the money for him. I think he was saying, I need to, spend time with friends and family, etc. So, yeah. But yeah, again, my theory on DraftKings, and look, you got to realize part of my thesis is already priced in. I mean, look at where the stock was this time last year. It was an $18 stock. Now it's almost 100 times more than at $30 a stock. So part of this is priced in that the numbers probably look better for DraftKings right now. I don't think it's a secret that more people are gambling this time around this year than they are last year. I think maybe people are overlooking how significant it is. Like every single person, I feel like I'm talking to, whether it's at work, whether it's my buddies, whether it's at the bar, like these guys sitting behind me at the Lions game on Sunday, we're talking about their, prop bets they had on the game and everything. So it's just like, I don't know, maybe I'm not seeing it clearly right now because I've been just hearing so much, and it's like maybe my circle talks about sports gambling more than others, but it seems like pretty much everyone and their mama is gambling on sports right now. So I want to check out I might check out some options on the stock. All right. Any other stocks the chat wants us to check out today? Otherwise, we can take a look at some of the top headlines of the day from Benzinga.com. Oh, I guess we should talk about the Fed decision tomorrow. I mean, I think a no rate hike is pretty much all but priced in right now. As you can see here, the current rate in terms of basis points is 525 to 550. CME Group is saying 99.0% chance that we will stay at 525 to 550 basis points after the meeting tomorrow. So of course, I mean, if it falls into the 1% where we do get this quarter raise, you could see a big drop in the market. I don't think we're really in any position to get it cut after, of course, we saw inflation started to pick back up last CPI report. So, the decision will be one thing that will come out at 2. You'll probably see the market react a little bit, but I mean, come on, guys. Like, let's be real. I don't think we're seeing a cut. I don't think we're seeing a raise. This is pretty much all but priced in. So as long as you don't see some shocking surprise, then we shouldn't really see any like massive drastic market reaction after the announcement comes out, unless there's of course some sort of like option squeeze or something. But then at 2:30, Jerome Powell will speak about the decision, and that's where we'll really see the move, because it's going to be about listening to Powell's tone, hearing what he's saying about the potential that the Fed raises more in the future. Of course, if we kind of take a look at his recent past talks and what he said, we can make we can guess what he's gonna say. And here's basically how it's gonna go down: is Jerome Powell's gonna get up there. He's basically gonna say, "Hey, look, we've made progress in inflation coming down. We're still not at our target yet. The job's not done. We're gonna look at data." He might even outright say, if the CPI goes up again, then we'll have to raise rates again. If it doesn't go up again, if it stays where it's at or continues to drop, maybe they can, not raise again. But I mean, and we broke down the CPI. A lot of that was from gas prices. So I really think, and again, the market's never this simple, but I really do think you can kind of just look at gas prices, take a look at them. If it seems like gas prices, and especially diesel, is starting to come down, then that could be a good sign that inflation will start cooling finally, or continue to cool and not pick back up like a lot of people are worrying about right now. You can see here gas prices. Diesel is cheaper than it was a year ago. About $4.58 a gallon versus $4.95 a gallon 1 year ago. That's a big difference, but you can see, look right here. I mean, just in the last month, a month ago it was 435, and now it's 458. So that's about, a 23-cent increase on diesel. And that doesn't sound like a lot, but when you think about the trucking industry and how many trucks are out there using diesel and how many gallons of diesel are going into those semi trucks on the road every day, there's, probably hundreds of thousands of gallons of diesel sold. Now every single gallon is basically like a quarter more expensive than it was a month ago. Of course, it's going to make a big impact when you kind of extrapolate it like that and look at how many exactly how many barrels that is. And when it's a quarter, 25 cents gallon, then that's significant. Highest recorded average price. I mean, holy cow, this was crazy. Regular gas was $5 a gallon. That was June 14th, 2022 at the same time. Diesel was $5.80. So yeah, I mean, we've come a long way, but we're just not really where you want to be yet. Let's go over to Benzinga.com real quick and just see some of our top headlines before we yeah, I know we talked about oil last week and it got a little heated. I don't want to, I don't think this show should, we should never strive to bring politics into it. I will say I did look more into it. It doesn't matter where you look in terms of sources, whether you're looking at, the oil price website, or you're looking at Financial Times or whatever. Like basically you know, the recent price in oil increase has been, can be attributed to a lot of things, including production cuts in Saudi Arabia, including things going on in China, including concerns about geopolitical tensions. Unless you have a very, it'd be very hard to make the argument that because we decided to stop drilling in the future in certain parts of Alaska, that's what's causing this acute price increase in oil, or blaming it on, I don't know. Like, again, like, you can go look up why oil prices are up over the past couple weeks, but I don't think it has anything to do with really U.S. politics at all, or U.S. Actually, fun fact, right now in the United States, we are producing more oil, like, per week in terms of barrels. I was looking at it today, than any other time. Oil production, U.S. Let's look at some of these numbers real quick, because this was actually shocking to me when I was doing my research. I had no clue how much oil we were producing right now. It's on pace to pass any other time going back to 2008. This is U.S. field production of crude oil, thousands of barrels a day. So you can see right here, we were on a gradual decline from like the 80s all the way down to 2010. Started to pick back up as we came out of the Great Recession, dipped again. Trump came in office. We started pumping more oil up. Bam, hit huge drop off when COVID hit. And now we're right back to where we were at the highest. I mean, June 2023, 12,844. The all-time high is 1,300 in November 2019. So we're right there. We are right there in terms of, we're about 160,000 barrels off, and we're expected to pass that in July, which this chart's not showing right now. So we're in July, August, September, and I'll drop this link in the chat if you guys want to check it out. We're producing a goddamn lot of oil. Yeah, I mean, there's and again, like, there's a lot of things going into there. Policy wise, I mean, there's yeah, here, I'll pull this up. I mean, you had the in the Dallas Fed Energy Survey, where they talk to a lot of these um, oil companies and manufacturers, they basically said it was from investor pressure, the reasons they weren't renewing, signing new leases, starting more production. Because I mean, think about it. If you're an investor in an oil company and supply is somewhat limited and you can sell oil for $100 a barrel, why would you want to start making more and then that price goes down? Like, here, I'll pull it up. All right, while I'm doing this, while I'm finding this, uh, let me know again if you guys have any stocks you want me to check out. I mean, look, you can't really have it, always. Like, obviously, the oil industry isn't that environmentally friendly. Like, there's been a lot of things happening there, so you would probably need to do and if you were really worried about the ESG part of clean energy, like in terms of how many animals were being harmed and whatnot, you would probably have to do the breakdown of versus different types of energy. Yeah, let's take a look at Instacart. I mean, I'm sorry, like I won't go out and actually short this just because I don't even know if you can right now, really, but okay, I don't think Instacart is listed on Benzinga Pro yet, but here's the thing: is right now we just got done talking about gas prices, oil prices, inflation, still being still hanging on. What is like the number one thing people are complaining about when it comes to inflation? Obviously, rent is one of them, but then also groceries. Like that is like the number one place that people are still feeling the pinch when it comes to inflation is groceries. Like you go to a grocery store and you buy something. I mean, okay, I will say it's kind of funny when you see people like make these posts on Twitter now and they're like, this is what $100 a grocery looks like, and they're buying like all this shit that's like I don't know, like not even really like food. Like they're buying like I don't know. I just saw one the other day. I can't think of I don't know, like 3 things of Sunny D. It's like, yeah, okay, maybe if you're spending like $3.99 on a gallon of Sunny D, maybe I don't know. That's just not smart grocery shopping. Look, my groceries are very expensive too. You can make it if you're going out of your way to try to find like deals at the grocery store. I have been able to find some recently. I have been able to find some staples that are somewhat affordable, whether you're talking rice, chicken, potatoes, all these things. And then I've noticed, I feel like I'm seeing a lot more markups on those kind of produced and what's the word I'm looking for here? Like packaged goods, cereal, stuff like that. But either way, groceries is still like the number one thing that I'm seeing people, rightfully so, complain about the prices of. What makes groceries that much more expensive? Getting them delivered. Instacart IPO indicating $42 a share, IPO priced at $30 a share. So you're telling me Like the average American right now is complaining about their grocery bill, their, whatever it is, 20% higher. Now, whatever you were going to spend on groceries for the next week, it was going to be $150. Guess what? It's $200 now by the time you take, Instacart's fee, the delivery fee, the tip for the driver, all these things. No way in hell, if people are starting to cut back and save money and try to pay off their credit cards, are they going to be using Instacart to deliver their groceries? Yeah, sure, you're going to have these, like, your tech people in San Francisco and New York City and Miami who might still be able to afford their Instacart, and, they're busy living their kind of pseudo-influencer lives where they're going from this and that and that. They don't have time to go to the grocery store, which, by the way, this is just my personal thing. Like, I think a lot of people, especially in today's world, need to feel really, really busy to feel important, right? Like, you got to be going from this meeting to that meeting to this happy hour. And I just don't have time to grocery shop, right? Like, my time isn't worth it to go grocery shopping. That's why I'd rather pay someone to do it $20 for me. I don't agree with that. I think it's the opposite. Like, I think, like, you should be able to take like an hour out of your day and hit the store. If you can't, then, you're not really, like, in a great, like, I want to be in a position where you can have a few hours a day to, run errands you need to run, go to the gym, like, do these things. If you're packing your schedule so tight and you think, like, oh, I'm living this, San Fran founder life, like my Google Calendar's booked 24/7. It's like, no, like, I don't think that's a good way to live. That's just my personal thing. Either way, I really don't think people are going to be using an Instacart much at all. If there is any sort of crunch, I think the same thing with Uber Eats. I actually, like, really don't like Uber's stock right here for that reason. Uber makes about a third of the company's revenue from Uber Eats. And then you take a look at a company like Lyft. I don't think Lyft has the same exposure to food delivery. So I could get talked into some sort of a short Uber, long Lyft trade here, to get long the rideshare game and then short the Uber game. How are the big the big three auto companies doing amid the strike? Stellantis, they're all hanging in there. All right, guys, 5 till noon. App, one of the best charts out there. Uh-oh. Something's going on here. Holy cow. Yeah, this is kind of reminds me of DraftKings chart we were looking at earlier with the nice rounded bottom. Oof. Tough day today, though, for AppLovin Corporation. Let's see. I don't even know what this company does. So, mobile app technology company. It focuses on growing the mobile app ecosystem by enabling the success. Okay, so it's basically just like it helps people make apps. Makes sense. AppLovin, good name for it. Love that. Yeah, I mean, put this on the radar. Chart looking good. Tough day today, like Jay said. Eventually, they eventually come for them all. Sunday delivery of beer. Oh, Toyota's up a decent amount. Let's check out TM. I really do like, I'm kind of biased. Holy shit. What the heck? Oh. What? I feel so stupid. I've been saying I love Toyota stock and I haven't been buying it. Wait, you're telling me this thing was... What the hell this thing 3 months ago, June 2023, was 130. Now it's 194. What the heck did I miss on Toyota? I mean, I like Toyota. Okay, because here's the thing. I have a Toyota. I've literally, like, since I've been 16, 10 years ago, I've, like, only driven Toyotas. my favorite. I'll probably always buy a Toyota. Love it, love it, love it. I'm not paid or sponsored by or a Toyota spokesperson. I just genuinely like the product, like the car, do not have issues with them. Um, I have like a 2021 Corolla hatchback I'm leasing. It can like drive itself on the highways and stuff. That's why I think like people don't realize how, kind of innovative Toyota's technology is. Like if anyone's going to be, right there with Tesla when it comes to self-driving and AI and all these things, I think that Japanese tech is very strong. I really do like Toyota. I think their EV and, obviously they have the nice luxury play with Lexuses. I'm just a big fan. I think the company pays a decent dividend. I think historically, though, again, like the margins have just not been great for car companies. Let's take a look at the weekly chart here. I mean, Toyota stock has done pretty well over time, actually, looking at it. But I mean, relative to like a lot of real tech companies during this time, Toyota wasn't doing as strong. But holy shit, this run has been absolutely bonkers for Toyota the past couple months. I've somehow missed this. But all right, y'all. 11:58. We're gonna go ahead and peace off now. Follow me on Twitter at AaronBree5. Make sure to follow Benzinga on Twitter at Benzinga. Give us a follow on TikTok, YouTube, Instagram, you name it. We'll be there. Peace and love, y'all. We'll be back on Thursday.